My name is Adrian Navarre, the CEO and founder of Ticker Trends. Recently, I was having a discussion with a very knowledgeable friend who's extremely impressive. He knows a lot about many things. He's much older than me, much more successful than me. And I was having a conversation with this person, and there was a topic that came up that I realized I had more knowledge than him about. And he was asking me questions about my experience with this one thing, even though he is holistically more experienced in most things than I am. So, what I started to realize is this experience of launching a hedge fund is something that not many people go through, even if they work in finance, even if they work in the data industry, even if they work with alternative data. It doesn't necessarily mean that you have experience or know what launching a hedge fund actually looks like. And fortunately, this is something that I have done in my life. I've gone through the process of the legal setup, compliance setup, raising capital, pitching to investors. I've done the whole 9 yards. And although I'm sure there are other people who might have more experience doing this than I do, I can at least say I have some experience doing this, and so I can at least share what I've learned and some key takeaways that I've had in starting a hedge fund and what I've realized along the way. So first, I'll start kind of as if I was in this conversation with my friend, and what he was essentially asking me is, if I want to start a hedge fund, what advice do you have for me? Or what do I need to know that I won't know going into it? And some of the advice that I essentially came up with is first just talking about when to start the fund and what that should look like. Now, I remember when I first started my hedge fund, I would have conversations with some people and they would say like, hey, Adrian, I wish this was just at a later point. Like maybe if you had done this later, that would have been a better decision than starting it now. And I think that this is potentially the thing that a lot of people get stuck on, which is like waiting for the right time or just waiting until they have enough experience or enough knowledge and enough, they've gone through enough market cycles to where they can be really confident in starting a fund and doing that. Now, I think, of course, if you don't have a strategy or an edge in the market that you think you can take advantage of, then that would be a signal that you shouldn't start a hedge fund. But if you do think you have a strategy or an edge in the market, then my argument, counter maybe to what these other people were saying, or at least telling to me, is I think that you should go out and try it and just start building your track record. This was one of the main pieces of advice that I gave to this friend that I was talking to, which is he was asking me, what did you learn when you were fundraising? What did you learn overall in the industry when you were doing that? And what I told him is people care about track record. And one of the things that's completely out of your control when it comes to track record is the market environment that you get experience in and exposure to when you're building your track record. Because the thing is, you can have an amazing track record or really great returns. But the one thing that some LPs or some investors or fund of funds, what they'll tell you is, well, we want to see how your performance would have been in this like one-off situation or in this specific scenario that since you've started your fund hasn't happened yet. And the thing is, unless you were operating your fund for a very, very long time, this scenario would have never happened. So that's why I always bias towards when people ask me, when should I start a hedge fund? I say, just start it as soon as you think or you have an edge in the market. You should start it then and build as much of a track record as possible. I mean, worst case scenario, maybe your strategy doesn't work. You run it for a couple years and then you close it down and maybe you lose some money because you spent some money setting up the fund. But at least you started building the track record and you were able to disprove potentially that your strategy wasn't good, rather than never building a track record and then starting way later and having to wait another, let's say 3 years, 4 years for that track record to build up to a point where you could actually start raising capital from these bigger LPs. Now, of course, in this, there are many edge cases and nuances. If you're someone who already has a lot of connections and you can just phone a friend and raise $100 million, then your track record probably doesn't matter as much. And in that situation, then yes, maybe you can wait until you're 60 years old and you've worked in the financial industry for 30 years, and then you can start your hedge fund when you're 60. But if you're not in that situation where you can call up someone and raise $100 million for your fund, then I think having as much of a track record as possible is going to be the best thing that you can do. And it will maximize the chance that if your strategy is actually really good and able to withstand all these market situations, then you'll be able to prove that in as short of a time as possible. So that was one of the biggest initial pieces of advice that I told him, is start it as soon as you can, build a track record, even if you're not necessarily raising external capital. Take friends and family money, put your personal money into it, start managing it. Yes, it's going to cost some money in terms of the cost of operating a hedge fund. And when I say a hedge fund, I mean a private fund, because at a certain size or investor base, you do have to register with the SEC. And then there are more complex and expensive processes in terms of compliance and legal setup that you have to go through once you get to that level. But with a private fund, you're exempt from many of those processes in terms of the registration and compliance is not as complex. And so with a private fund, which is probably what most people will start with, the costs can be anywhere in the range of, on the lower end, of tens of thousands per year. So this would be around maybe $20 to $40 or $50,000 per year as just the fixed operational costs for the fund in terms of legal and compliance setup and accounting and things like that. So when you're running a fund, let's say you might not be able to raise external capital for maybe 3 or 4 years from the time that you start the fund, because you need to build a track record. Hopefully you have some friends and family money or a significant amount of personal capital to where that 30 or 40,000 or 50,000 a year is not going to completely destroy your ability to make money. But you're going to have to run that for about 4 years, and then, or a couple years until you've been in some different market situations. And assuming you have impressive returns and good risk management and good management of the portfolio overall, then you can probably start talking to larger LPs or other fund of funds or high net worth investors. You can always kind of be pitching to them on the way as you're building your track record, but just stay in contact with as many people as possible, make them aware of what you're doing. And then hopefully over time, you'll just be snowballing into more and more capital that you'd be able to manage within your fund. Now, another piece of advice that I gave him, and I think this is something that might be another misconception going into the hedge fund industry, is this idea that a good track record will just allow you to build a massive fund. I think this is something that is not necessarily true. Now, yes, there are people that have very impressive returns and really amazing strategies, and then that's what will grow their fund into a mega fund or $100 million, $1 billion fund, and their returns and strategy around that will carry them there. But most funds that get really big are not necessarily always doing that. Some of them are doing it much more based on relationships. But I'd say, for most mid-sized funds or just any fund in general, you need to be building relationships the entire time that you're operating the fund. So this was another thing that that my friend asked me is, who should I talk to, or when should I start reaching out to people, assuming I need to have a long track record to raise external capital. And I think this is another potential mistake that someone could make, which is saying, okay, I'm going to start my fund and I'm going to build a track record for 3 years, and I'm not going to reach out to anyone until I have my 3-year track record. I think this is another thing that you should not do. Instead, what you should be doing is you need to make people aware of the fact that you're building your track record and what you're doing overall. So let's say you've been operating your fund even for 6 months. Reaching out to potential fund of funds and making them aware of who you are, what you're doing, what your goals are, maybe talking to them, getting advice, asking what they need from you before they can feel comfortable making an investment in your fund. Those are relationships that will build and allow them to become comfortable with investing in your fund maybe a couple years down the line. So the asset management industry, it's not only building a track record, but it's at the same time building relationships and comfort with the people who will eventually allocate capital to you. So ideally, you want to be in a situation where you're not in a rush to raise capital. You have time on your hands, maybe a couple years where you can build a track record. And at the same time, you're talking to a lot of people about it. You're making them aware of it. You're having some calls. You're getting them on an email list, sending them like monthly updates, return updates, maybe investor letters, things like that. You want to get them in a loop where they hear about you, they constantly see what you're doing, they see the good times, the bad times, how you handle it, your total returns for each year. And eventually that's what will build their comfort into then when you have that 3-year track record. You can reach out to them and there's a way higher chance that they'll say yes. Or eventually it will naturally work out in a way where they will have seen your track record being emailed to them each month for the past year and a half. And now finally they're like, wow, you just posted a 20% return month. And we've been seeing your fund for the past year and a half. It performed well in the bear market. It performed well in the bull market. You just posted 20% returns. This is super impressive. I want to give you capital. I want to put money into the fund. So I think that's another thing that's really important. You have to be building relationships. And just like you shouldn't wait to start your fund, like for the perfect time to start your fund, I think you shouldn't wait to start contacting people and talking to people and telling them about what you're doing so that you can maximize your odds of raising more capital down the line. So those are just some starting points, maybe. And of course, there's no right answer to any of this. Someone might completely disagree with me on maybe some aspects of what I'm talking about. But I think the biggest takeaway overall from what I've said, hopefully, is if you have a really good strategy, and if you do believe that you have an edge in the market, then you should start a fund, because I mean that's the way to prove it, right? You're going to prove it. You should start a fund, and you can show those returns, get it audited, make it public, display those returns everywhere, make a deck, make it shiny, and if your strategy is really good, then eventually you will be able to raise money. Of course, I think the hedge fund industry is one of those industries where it is one of the most brutal in terms of you're either good or you're not good, right? You're either going to have a successful strategy and be able to make a lot of money, but you have to really be confident that you have that edge and you have that performance in the market that will back that, because if not, you're going to be stuck in a situation where you're spending $50,000 a year just to have this entity even exist. And you're never going to be able to raise external capital unless you're in the situation where you're in that camp that I described earlier of a person who can just call a friend and raise $100 million. If you're in that situation, then even if you have a bad strategy, you could probably still be profitable, because if you can raise $100 million without a track record, then even if you just kind of match market returns, you'll still be making a decent amount of money to operate your fund. One final thing, or one more thing I want to mention, is even once you have a fund and once you've been operating it and you start to raise some money, something that's important to realize as well is kind of how you're making money within this fund. Because I think it depends on your strategy, but you're going to have costs associated with the fund, and funds are not inherently super profitable unless you're really making those outsized returns. Whenever you get that management fee, let's say 220, you're making 2% management fee, you really have to be at quite a bit of capital for that to cover all of your base operational expenses. So really, you want to be in the range. I guess this really depends on every single person, but you want to be above probably the 10 or 20 million assets under management mark eventually. And then I think you'd only start making that more serious money or be considered a more established fund. Once you're in the upper end of the tens of millions or hundreds of millions of dollars, then I think when you think about a 2% management fee and 20% performance fee, then you could be making significant money. But you're also going to have expenses of purchasing research, purchasing data, purchasing information, maybe paying some analysts, which can be expensive as well. So there's a lot of interesting aspects to the hedge fund industry that you have to consider, and you also have to consider when there could potentially be more dead periods in terms of revenue, where if that management fee is not covering your entire operational cost, then you need to have some buffer in your bank account to be able to withstand those periods when you're not above the high water mark of returns that you've made in the fund. So that's just off the top of my head some interesting advice that I would say for someone who's considering starting a fund. Of course, if you have more questions or differing opinions, leave the different opinions in the comments, and feel free to reach out to me if you're thinking of starting your own hedge fund and have questions or want advice from it, and I can try to help as much as possible. And then, of course, if you are someone who has access to a lot of liquidity and you're looking for either a way to enter into the hedge fund industry or you need someone to manage your capital, then of course I have a hedge fund myself and I would be happy to discuss that as well. The whole reason I make these videos and I do everything online is to build relationships with impressive people, and most likely if you're starting a hedge fund or have enough capital to invest in a hedge fund, then that's someone that I want to meet and I want to build a relationship with, because I like people who are doing interesting things. Thank you all so much for watching, and I'm going to keep trying to make interesting videos like this on topics that maybe are not covered too often by people who actually have experience doing them, and I'll try to keep it as interesting as possible. Thank you.